Good afternoon and welcome to this week's session of Solid Finances. Just to get started, I'd like to thank our sponsors, those universities who are partnering to put this webinar series together. Montana State University Extension, North Dakota State University Extension Service, University of Idaho Extension, and Kansas State Research and Extension. Just to let you know, if you are looking for any resources related to the information that are in these recordings, or if you're watching live, those can be found on the website. That link is up there on your screen. You can take a look at the upcoming schedule, find any contact information for the presenters or hosts of the series, recordings if you missed anything, and then also any resources that we may talk about within a session. Some interactive tools that we'll be asking you to take part in using today. There's the Q&A pod at the bottom of your screen. Go ahead and ask questions using that. It is completely anonymous, so we will answer them as we go along, or some of them we may wait until the end, but we will get to all of your questions. And then also throughout the presentation today, we'll be asking some multiple choice questions and asking for your feedback. Some upcoming sessions. So after this week, we're kind of wrapping up our heavy investment type sessions, and we'll be moving more into home buying. So next week I will be presenting on steps you need to take when purchasing a home, and then the following week Joel Schumacher from Montana State University will be discussing your home loan options. Today, Luke Erickson from University of Idaho Extension will be talking to you about withdrawal strategies. And Luke is an extension specialist from University of Idaho Extension.
Yeah, great. Thanks a lot, Carrie. It's great to be on. I do want to apologize up front. I do have a little bit of a cold. There's some nasty things going around this year. Happened to catch one. Good news is the internet is not very good at sharing germs yet, so you're out of the woods on that one, but you do have to listen to me clear my throat a little bit as I present today. So apologies in advance. So yeah, we're going to talk about overall how do you use your assets during retirement, and with a specific focus on withdrawal strategies from your investment accounts. So my main objectives today will be to talk about realistic withdrawal rates, talk about strategies to manage withdrawals, potential uses of certain types of funds called automatic withdrawal funds, and then of course a little bit of a discussion on other assets that can be used during retirement. So those are my main goals today, to talk about those things. First, we'll start with the poll. Poll A, I know how much monthly income I'll need during retirement. Okay, so the responses came in, and looks like most of us have a decent handle. Some of us could use a little work, so that's okay. You know, that's where you should be, honestly. If you were an expert already, I would kind of wonder why you're on the presentation. Anyway, that's great. So let's go to the next slide. So when it comes to any sort of retirement estimates, there are a bunch of things that we have to consider. First of all, you know, what's the total amount of income that we think we might need? And of course, this is going to have to be a ballpark, because we just don't know exactly. A lot of moving pieces, a lot of factors that will vary from person to person, and even from year to year in our own lifetimes as we figure out how our life is unfolding. That being said, most of us can count on at least a little bit of Social Security. Some of us can count on pension benefits. We do need to account for our own savings, and that has to do with things like, you know, where are we at now? How many years between now and retirement? And of course, how many years we think we'll have in retirement. So how much time we have to save, and of course, how much time we will need to live off of those savings and other retirement resources. Our main goal in our discussion today is to make sure that you don't outlive your money. It's easier said than done, right? Because many of us will live to be the average age of somewhere around mid-80s. However, 50% of us will live longer than that, and unfortunately, 50% of us won't make it quite that far. So then, how do I address a huge group with these varying needs? You do have a 5% chance of living to be 100, and even 1% chance of living to be 105. That's assuming that you've made it to 65 in the first place. That's what the statistics say. So, how do we actually address this wide range of potential needs? Maybe I will need to live off of my retirement for 10 years. Well, maybe 20, maybe 30, possibly even 40. We'll get to some of that today on how we kind of figure out from some of these unknown factors how we figure out how to live off of our money. So here's our next poll. I know how long I will live. So go ahead and put a response to that question. Okay. Those are pretty much how I expected the responses to come in, because none of us really know, honestly. We do have some clues, our family history, say what has happened to our parents or genetics, grandparents, things like that. So we may have a little bit of a clue, but in the end we just don't know. So there's a wide range of needs that we'll need to discuss in today's presentation. So just to illustrate this point again, if you're a male, you have a 75% chance of living to be 78, 50% chance of living to be 85, and 25% chance of living to be 91. If you're female, you will live a little longer. That's lucky you. That's great. 75% chance of being 81, 50% chance of living to be 88, and 25% chance of reaching 93. Now, the orange line has to do with a couple situation. What are the chances of at least one spouse living to be 86? 75% chance, right? So, and then 50% chance to be 91, and 25% chance that at least one spouse will be 96 or make it there. Why do we bring that up? Because when we're planning for retirement, it's not only our individual selves that we need to worry about, but it's our spouses, it's our family members who may or may not be dependent on that retirement income for things. So to plan how long that money needs to last, we also need to plan for not only ourselves, but how likelihood of everybody else living to be ripe old ages. Excuse me. Okay, so what this slide shows us real quick is that traditionally many of us could rely pretty heavily on Social Security and pension plans. But moving forward, we'll have to rely increasingly on our own savings, our own investments to see us through a comfortable retirement. Now, before retirement, we worry about things like accumulation, long-term growth, where we started from, our current savings, time to recover from any sort of market downturns, and of course, sheltering our growth from taxes. Now, during retirement, or after retirement, I guess, we need to worry about things like disbursements, right? So how much do we take at a time? Do we take all of our money out all at once when we retire, put it in the savings account, or do we worry about something like long-term growth where we keep a portion of it invested? We have to worry about, of course, income, right? So, if you take all your money out at once, does that mean you're going to have to pay a huge tax bill, or do we want to protect ourselves from taxes by spreading it out over a number of years? Are there other reasons to spread it out besides taxes? What if we do decide to keep some of it invested over the long term? What about those downturns? Well, we're using this money, so that it creates a potentially bad situation where you go to use your money and all of a sudden the market's crashed and you don't have as much money as you thought you did. So that can be a very scary thing. Of course, there are also minimum required distributions on pretty much, I would say, most retirement accounts. I think the Roth IRA is a big exception to that. But most retirement accounts, you will have to, you're forced to take withdrawals. So how do we calculate all that? And also wanted to throw out there that when we talk about how much we will actually need to replace as far as our income before retirement, let's take 3 or 4 or 5 years before retirement, what was your income and standard of living? Well, in order to maintain that standard of living, the good news is most research says that you won't need 100% of what you were making. You probably need more, around 70 to 80%. A couple of reasons for that. One of them, assume that you have paid off your home, so that's a bill, a pretty big bill that you don't have to worry about. Also, maybe things like commuting costs to work, you don't have to worry about those. Of course, a huge one is that idea that, well, we were actually taking a significant percentage of what we're making and investing it for the future. Well, once you retire, that more or less is the future you were planning for, and so you don't need to save anymore. In fact, you do the opposite and start taking some withdrawals from those savings accounts or investment accounts. So I wanted to get in a little bit to some withdrawal rate studies. So, of course, I could talk about Social Security and pensions, but that's not really the purpose of today's discussion. So I'm not really going to address that too much. I am going to focus on our own savings and investments and how we actually use that during retirement, and especially if we want it to last. So this is an older study, but a pioneering study that is a good one to reference. Basically, it looked at different withdrawal rates over time, given different portfolio makeups. Okay, so what does that all mean? I'll actually show you some examples. In fact, what I'm going to do is skip ahead right here to this slide, because what this shows is if we had, so let's say that we were just really risk averse. We don't really want to keep our investments, we don't want to keep it fully invested in the stock market. The stock market scares us. We're worried about market crashes. So instead of doing that, we're going to take most of our retirement savings or investments, and we're going to move it over to a little bit more safe investment bonds, right? Now, I do apologize. I know graphs can sometimes be confusing, a lot of information. So I'll try to keep it simple, but the red bars indicate a failure rate. So in other words, this investment portfolio will run out of money in this 30-year period. Now, remember the age chart that we were looking at, we definitely want to make sure that our money will last at least 30 years. That will cover, for most of us, most of our retirement years. Many of us will not live to outlive 30 years in retirement, basically. So that's the assumption we're making here, 30-year period. If you take a 12% withdrawal rate, doesn't really matter what you're starting with, but for round numbers, we could use just $1 million. As you're starting, just that's how much you were able to accumulate and earn and end up with through your working years, and that's how much you started with retirement as far as your investments go. I understand a lot of us may be in different boats, but that'll just be a good round number to start with. So for example, a 12% withdrawal rate, we'd take 12% out each year, and by the way, the withdrawal rate I'm referring to is an inflation adjusted withdrawal rate. So you start your first year in retirement of the 30 years with a 12%, and then you don't continue to take 12% every year off of the remaining balance. You take the original amount, 12%, and then you adjust it every year after that for inflation. So it's only 12% of the beginning balance. But with inflation adjustments, so that you can maintain that lifestyle. That's kind of the point of doing these withdrawal rates, so that you can maintain your lifestyle. Okay, I keep interrupting myself, but here, let's get back to this withdrawal rate. If you take 12%, you're guaranteed to run out of money before 30 years runs out. 11%, same story. 10, 9, 8, 7, even 7%. So 6%. And down to 5%. 5%, of course, of $1 million is $50,000 a year. And by the way, if you want to do some quick math, $50,000 a year, if you're not invested at all, so let's say you take $1 million out and put it in the bank and live off of that and do $50,000 a year, you will run out in 20 years, right? So has a 100% failure rate of trying to make your money last to 30 years. So at least bonds will get us past that. With a 5% withdrawal rate, at least our money has a 50% chance of lasting 30 years. The nice thing, though, 100% bonds is a 4% withdrawal rate. According to this study, is you are virtually guaranteed to not run out of money. Now, what are we looking at here? We're looking at historical market returns. It's from 1927 to the mid-2000s. And so it's just that idea that no matter what scenario you're looking at, even if you started right before the Great Depression and retired, and then wanted your money to last for 30 years, well, if you took a 4% withdrawal rate, according to this historical analysis, then you would have been fine. You would have been able to maintain that lifestyle and not outlive your money. However, if you took higher withdrawal rates, instead of, I'm not happy with $40,000 a year, I need $60,000, I need $70,000. Well, you go for that $70,000, then, again, 100% chance that you will actually not be able to stretch your money out over 30 years. So that being said, what should we do? Should we take our money out and put it in the bank when we retire? That is an option, and one that people might do. Again, you got your tax bill you might have to worry about depending on the type of investment plan you had. But not only that, the even bigger risk, in my opinion, is that idea that that money is not going to last very long, because it's not going to keep up with inflation, and you're not going to be able to maintain your lifestyle for the your whole potential retirement. Now, of course, if you turn out to be one of those people who doesn't live very long, then you will not outlive your money. But of course, we don't know that. So we're trying to plan for at least 30 years of coverage, being able to maintain a lifestyle. Okay, that being said, what if we did a few things a little bit different? What if we actually kept some of that those investments actually invested in the stock market? So here we see a portfolio that's 50% stocks and 50% bonds. Bonds, again, considered a little safer, still in the market, so to speak. You're not entirely out of the market, but 50% stocks, that means you're very much in the market. That means you will feel all the ups and downs. That being said, though, big picture, what does it actually mean? Well, again, if you need a lot of money, 12% of your starting amount, then again, you are pretty likely to run out, or I should say 100% likely to run out. But it does actually give you some more wiggle room with these sort of medium-sized withdrawal rates, 10%, 9%, 8%, especially that 7%. We can flip back real quick. 7% with 100% bonds, you're guaranteed to run out of money over 30 years. However, if you're in this 50-50 portfolio, it's only a 10% chance of running out of money. So in other words, in keeping 50% of our investments in stocks, we actually give ourselves a lot more wiggle room with that 7% withdrawal rate. And of course the 6% too, and it virtually reduces the risk of running out of money for that 5% withdrawal rate. So let's say I need $50,000 from I'm starting with $1 million nest egg. And I do a 5%, which is 50,000, of course, inflation adjusted every year after that. Then I am pretty much not going to run out of money, historically speaking. And of course, that includes the Great Depression scenario. You go to retire, and the Great Depression happens a few years after that. So that's some really good peace of mind right there, in other words. So a lot of us look at stocks as being a very risky thing, but in reality, we look at this study, stocks actually reduces a lot of risk. Of course, assuming that we're shooting for a certain lifestyle and need to make ends meet. And so introducing stocks into our portfolio is a potentially good thing. And so here's another portfolio, 75% stocks, 25% bonds. Now, if we compare the previous one to this one, you actually see it actually brings back a little bit of risk in that 5% withdrawal rate area. The reason for that is because the stock market is notoriously very volatile, and especially in that case, if the bulk of your investments are in stocks and you go to retire and then there's a huge market crash, that could potentially cause some or increase your risk of running out of money prematurely. But of course, if you needed more money than that, it actually reduces the risk of running out of money if you have one of these higher withdrawal rate expectations, 11%, 10%. $50,000 a year is not enough. I need $100,000 a year, so you do that 10% withdrawal rate. Well, according to this portfolio, 75% stocks, 25% bonds, you have a little over 50% chance of running out of money. But that's a lot better than it was when we were 100% bonds, right? Let me go back there to bonds. You do a 10%, you're guaranteed to run out of money way before that 30-year period rolls around. So there you go. That's why we talk about withdrawal rates. That's why I also really like to emphasize that taking money out of the market when you retire introduces its own set of risks, and again, pretty much guaranteed that it will not last 30 years as we might have an expectation to. This is just another way of looking at some of this information. It's slightly different information, but this is a Monte Carlo simulation. But basically says, somewhere between 4 and 5% withdrawal rate is kind of that sweet spot. If you can lean more towards 4, that's going to give you more of a guarantee that you won't run out of money during retirement. And then here's another study that just basically says with these different portfolio amounts, again, inflation adjusted, through these years, 1926 to 2007, what kind of withdrawal rate could I have sustained given any 30-year period during this, historical period? So it says 75% stock and 25% bond portfolio. You could have sustained a 5.9% withdrawal rate and not run out of money, no matter what 30-year period you pick during that time. And then, of course, a 50-50 is a 5.1, slightly less, and then 25%, 75% bonds is 4.2%. So it's kind of that sweet spot. You want your money to last, keep it in the market, and take about 4 or 5%. If you want to be on the very conservative side, take a 4% withdrawal rate. If you want to introduce a slight small risk that you might run out of money, upwards of 5 and 6% you might be able to get away with that. Okay. So basically these studies are looking at safe scenarios, just making sure that we're not going to run out of money during this time. As I mentioned, that 4 to 5% is kind of that sweet spot, but you can play with that given your investments and what you're willing to stick with. What this slide shows us excuse me, is that the sequence of returns does matter. So I mentioned what happens if you go to retire and the Great Depression happens. Well, this scenario is not quite that drastic, but it does show us the downturn of the mid to late 70s could actually severely affect a retirement account. So again, an example, I went to retire in the late 70s, and then there's a huge market crash, and I lost, and I thought I had $500,000 to $500,000 worth of money to start retirement, but then 2 years after that, I have significantly less, lost almost $150,000 worth of my in my nest egg. But then, of course, years after that, some of them are good, some of them are not so good. Of course, stock market does what it does. But because we're taking money out this entire time, then we run out of money within 20 years in that case. Now, what this second graph shows is exactly reversed sequence of performance. And so I don't know if that's going to make any sense, but basically it's just that idea that the stock market does what it does and we never know what it's going to do. Sometimes it's going to go up, sometimes it's going to go down. In this first scenario, it went down when we first retired. In the second scenario, it actually goes up when we retire. And so of course you start with 500,000, but over the years, it actually earns money. You're taking money out during this time, but you're still earning money, and that's a really good thing. Until you get to the last few years and you've almost reached 2.5 million. You started with 500,000. That's awesome. That's great that we're earning money during retirement, and while we're living off of this too. But then of course it has the market downturn, but of course that market downturn doesn't really affect us that much because we've got all this growth in the meantime. So sequence of returns does matter. If you do retire and then there's a market crash in the first couple, let's say 5 years after you retire, that could significantly affect your ability to earn money during retirement, or may even introduce the risk of running out of money during retirement. Now that being said, understand what I already showed you is that even if this first scenario happens and you're doing a 4% withdrawal rate, then you're not supposed to run out of money. And I'm supposed to, let's see, I should have looked at the withdrawal rate on this. I think it's a 5% is what we're looking at here. So you will run out of money. Theoretically, you should not run out of money with a 4% withdrawal rate. So that would be interesting to see what this graph would do if instead of doing a 5% withdrawal rate, we're doing 4%. But the point is that we do need to take care of that. So we'll get to that here in just a minute. But first I want to ask you a question. Poll C, I plan to use some type of withdrawal strategy at retirement. Okay, so our responses are great. Looks like absolutely, mostly, and sort of, kinda. And I understand this is kind of what I expected. It's like, I understand I need to do something, but what is exactly right for my situation? And there will be differences. We all have differences in, our risk aversity, uh, what we're starting with, what our expectations are, lifestyles, and of course, as we mentioned, how long we plan to live or at least plan to have to cover with our own investments. So anyway, before I get to covering this risk of market downturns, I wanted to show you how to calculate, um, you know, how much you might need, just simple ways to figure it out. So let's say our annual living expenses right now are $40,000 and we can expect $20,000 in Social Security. That means that we'll need to make up $25,000 per year of annual living expenses. Well, how do we do that? Let's do some quick math. You do 25,000 times a 5% withdrawal rate. And so that'll kick out a number of $500,000. That's how much we would need to start with if we want to maintain our lifestyle. Now, of course, there are many different options. If we can't do that, well, first of all, if we're short but we still have years between now and retirement, then of course we step up our game, save a little bit more, invest a little bit more. If we can't do that, there's other things. Delay retirement a little bit, work during retirement. There's a lot of different ways to make up this gap, right? But again, quick and easy calculation to figure out exactly how much. If you can plan on these withdrawal rates that I just talked about, a 5% or a 4% withdrawal rate, how much would you actually need to start with in order to maintain a lifestyle? So that's how you would do it. And then, of course, how do you adjust for inflation? I mentioned all those figures we were looking at were inflation adjusted. Well, you take that original amount that you're starting with, 25,000 in this case, in this particular calculation, and then we adjust it upwards by 3% for that first year. That's our first year we're adjusting for inflation. And then, of course, the second year you would take the 25,750 and then adjust that upward by 3%. And then you would continue to do that for every year after that. So in other words, once you know what your first year withdrawal will be, you can calculate exactly what all the subsequent years will be, because it's just a simple percentage increase of 3% to keep up with inflation. So that's how you do that calculation. Okay. Now, in order to handle these market downturns that we talked about, or that I mentioned earlier, there are many different ways to go about it, but one that I like is this idea of a 3-bucket strategy. So it's, let's see if I can remember the guy's name. Frank Armstrong introduced this concept, or at least made it somewhat popular. But basically, it just allows you to take your whole portfolio. I did talk about, 50% bonds, 50% stocks, or 75%, 25%, what have you. One possible way to mitigate that risk of a market downturn is to go ahead and use this bucket strategy. So what does this bucket strategy even mean? You got 3 buckets. Bucket 1 is the money market with 1 year of living expenses, essentially what you're living off of, I suppose, for that given year. Bucket 2 is short-term bonds, or basically very conservative type bonds. And you can have, so this guy Frank Armstrong recommends about 5 to 7 years worth of living expenses in these lower risk investments that are still earning a little bit of money, but not fully invested in equity funds, right? The stock market itself, if that makes sense. And so the idea behind this then is you got a bunch of different buckets you can withdraw from. Oh, by the way, bucket 3 is equity funds. And so the percentages recommended are, and this is the hypothetical scenario of starting with 500,000. You'd have 25,000 there. That's 1 year's worth, basically 5%. Bucket 2 would be, I think there's about 7 years worth, and then the rest is in bucket 3. The percentages turn out to be something like 5%, of course, and then 20% and 75% in bucket 3. So, so then, of course, there's different scenarios. What if, we go to retire and then we have some up years? Well, then you just continue to take money from bucket 3 because the market's good and it's strong, so it's okay to take some money out of that bucket and to live off of it, a year at a time, or that scenario. The scenario 2 says, what if bucket 3, or the U.S. stock market, has a down year? It crashes. That's a nice way of saying that it crashes. Bucket 3 has a down year. Of course, most of us understand when the market is bad, that's the worst time to sell. You're basically locking in your losses and making them actual losses instead of paper losses. And that is not something we want to do. And so we're trying to, retire and live annually off of withdrawals from this retirement portfolio. But what if we have some down years right off the bat? That could significantly affect how much money we have to live on those years and, of course, subsequent years. So how do you mitigate that risk? Well, the bucket strategy says let's go ahead then and just take some from bucket 2. Because while it may have dropped during a market crash, it will not drop quite as much as bucket 3 as far as it's in bonds instead of equities. And again, these can be very conservative bonds, even government or municipal bonds if you choose to go that route. So something that's just a little bit safer. You could live off of that for, say, up to 5 or even 7 years, according to the strategy. And that would give you, in most scenarios, give you plenty of time for the equity portion or bucket 3 to actually recover and then to become strong again. So then once the market recovers, then you go ahead and take some money from bucket 3 and refill buckets 2 and 1. And so it's just that idea that, excuse me, that just because the bulk of your investments are in the stock market or in equity mutual funds, for example, doesn't necessarily mean you have to draw on them every single year. You could use some of these buckets and draw on those in times of market crashes and things like that. So that's one way to mitigate that risk. Again, in most situations, we actually wouldn't need the bucket strategy, but there are those cases. Let's say I go to retire right before 2008 and everything crashes. Well, that actually happened to people. Many people made mistakes. Many people cashed out. That's a terrible thing to do during a market crash. But what you could have done then is if you had planned ahead, you'd have these buckets ready to go, and the market crashes. Well, guess what? You already have 7 years worth of living expenses that will see you through that market downturn. The market will recover, which it did. And then when you've run out of money in those first 2 buckets, then you just go ahead and replenish those buckets with bucket 3 once the market's recovered. Okay, poll D. I think the bucket strategy might help me during retirement. Okay, very good. I like the responses. A little bit of a range there, which I expected. I would be shocked if everybody had the same opinion, because we all come from different points in life and perspectives with different goals, but it looks like for the most part it could be a useful thing. So that's good to know. So I mentioned earlier, what then happens if we do our calculations and we decide we're just not going to make it? We have 5% withdrawal rate, but it's just not going to cover our living expenses. It's not enough. Well, there's a lot of different things you can do. Of course, you could increase your withdrawal rate. And that's totally fine as long as you are willing to accept the increased risk of running out of money during that 30-year period that we talked about. You could, of course, reduce your standard of living. We talked about some of these. Get help from somebody else who has money. That'd be nice. Get a job to supplement during retirement or even delay retirement. So there's still plenty of options. You figure out this 5% withdrawal rate and you think, okay, that's something that I think would work and I like it and I want to do it. And then you do the math and then you get discouraged thinking I can never reach that goal of starting with $500,000 or $1 million or whatever it would take to maintain lifestyle. Well, again, keep in mind you do have plenty of options to also help fill that gap besides withdrawal rates. Wanted to talk a little bit about automatic withdrawal funds. We just talked about managing our own portfolio and doing our own withdrawal strategy. There are actually some fund options out there by different companies that you could just roll over any retirement investments into this managed payout fund. Essentially what you do is you tell them the lifestyle you would like to have and look at the total of what you're starting with, and they'll give you different options of how to invest. And some of them are aggressive and risky and other ones are not so much, but it's basically to meet your retirement goals, to give you a certain amount of payout each year from these funds. And so these professionally managed funds, they will decide exactly what to invest in order to reach those goals. It can be a good way to go, but there are some downsides, of course. One is on the one side, if you have unrealistic expectations of how much money you can actually get out of this fund, then they may or may not, but they may choose to invest very aggressively even in things besides mutual funds, something that's even riskier than, say, an index fund, which could introduce more risk and increase your chances of a market crash wiping out your funds type of a scenario. So there's that risk. There's also the risk that you have a bunch of money, then you sign up for this automatic withdrawal fund, and they put you in something very, very conservative. Well, your goals were conservative to begin with because you have a somewhat low lifestyle given the nest egg that you brought to the table. And so they might invest you in a very conservative manner with the idea that you won't lose any money, but it's just enough to keep up with your lifestyle needs. In other words, you could have done more with that money, but you just did the bare minimum to make sure you didn't run out. So it's not necessarily a bad thing, but just understand there are pros and cons to going that route. Unlike annuities, they're not guaranteed income, so if the market does things unexpected, then you just kind of have to deal with it. So again, a little bit of information on managed payout funds. Oh, sorry, I mixed up my slides, it looks like, but yeah. Again, if you don't have enough, late saver strategies. Oh, so that's why I brought it up, because there are other ways to go. You can purchase an immediate annuity. You can relocate. You can also obtain a reverse mortgage. So there's the different options. We're not going to spend a lot of time on these, but I did want to compare annuities to the withdrawal rate option. First of all, what is an annuity? It's a product through a life insurance company where you take either you pay into it before retirement, or in a lot of cases you actually take a lump sum, your investments that you've been saving up for during retirement, take that lump sum and purchase an annuity with it. And so basically you create a guaranteed stream of income, which is a good thing. And on the plus side, what annuities do is if you think you're going to live to be 95 or 100 years old, annuities might actually be a good way to go, because you basically put in your lump sum. The life insurance company will bet on the fact that you will live to be an average age of 80s, mid-80s. So if you outlive that money, you will actually get more money out of it than you put into it. Now, of course, insurance companies are not dumb, and if they want to stay in business, they will find a way to not lose money. In fact, they will find ways to make money off of these products. Well, how do they do it? Basically, they use the actuarial tables, law of large numbers. Somebody's going to live to be 100, but they will be offset by somebody who pays for an annuity who only lives to be 67. And so in the case of that person who pays a huge lump sum up front for an annuity and then dies a few years later, well, they paid a whole bunch of money for a product that they didn't really benefit from very much. Now, of course, that's offset by the person who does live longer. And of course, insurance companies take their fees and those sorts of things. They're in business to make money. That's what they do. And so in the end, are you left better off or worse off with an annuity compared to just managing your own portfolio with withdrawal rates and that sort of thing? It's up for debate. In fact, it kind of depends on how long you live in it. That's anybody's guess. However, again, understand that if you did go your own route, one of the main benefits of managing your own portfolio is it's all kept in-house. It's your money. You live off that money. If you do pass away, before that 30-year period, well, guess what? You just left a pretty nice nest egg to any of your dependents or heirs, or however you want to look at it. In annuities, that's not usually the case. There are some annuity products that have death benefits and things like that. But in the end, like I said, it's kind of a middleman to use an annuity where you could do a lot of this yourself. Now, again, I do fully understand there are pros and cons to both methods. So I'm not necessarily recommending one above the other, but I am saying that that's the nature of annuities. They essentially charge fees for some peace of mind is what it comes down to. And if that is something that is valuable to you, then I would say go for it. Okay, so I talked about those points there on annuities. We don't need to dwell on this too much, but just an example of what an annuity payments might be, and you can adjust these for inflation every year. You can actually choose the adjustment rate. Then, of course, you'll start with a lower initial payment. Just things like that. So this isn't necessarily an annuity presentation, so like I said, I'm not dwelling on those details too much right now. I did want to touch on reverse mortgages real quick. Are they good? Are they bad? They are pretty, I'll just say they're a very expensive product. In most cases, you're better off selling a house and downgrading to a smaller place or even renting, something like that. But in the end, A house is more than just a place to live. It may have memories, sentimental value, things like that. And I understand that. But those who opt for reverse mortgage products end up paying quite a bit for to be able to tap into that equity of the home. And of course, what happens is if your heirs want to inherit the house, then they will actually have to pay back that portion that you used if they want to actually maintain ownership of that home. Because basically, a reverse mortgage is exactly what it sounds like. It's like a mortgage until you pay off a mortgage, the bank actually owns your home. And the same thing goes with the reverse mortgage. Once you start tapping into the equity, then the bank actually owns your home through that reverse mortgage contract. So just something to think about. How does it work? You can get a lump sum from equity. You can open a line of credit from it. You can do it as a cash advance or even a combination. You do have to fit certain criteria, certain age, if you want to go that route. Is it right for you? You can still live there. You're still responsible for all your taxes, maintenance, things like that. But it is a way to find some money if you don't have any other options and you want to stay in your house. So, okay, so what have we covered today? Withdrawal rates, withdrawal or strategies to manage withdrawals. Talked a little bit about automatic withdrawal funds or payout funds. Talked a little bit about annuities and reverse mortgages. We, of course, did not go into every single detail we possibly could on this subject, but hopefully covered some of the basics, and I believe that is all that I have for you. Here's a last poll, I think. Poll E, based on today's program, I plan to make some changes in my retirement plans.
Okay, well, this is being answered, Luke. We did have a question come in. As a strategy, my husband qualifies to draw half of my Social Security, waiting to draw on his until age 70. We will have to draw down more from other sources to accomplish this. Is this a good idea?
It sounds on the surface like it might be, but I would have to look a little bit closer at the details, honestly, to give true and honest advice in that specific situation. But yeah,
and always you can email if you want expanded answers. You can email the presenter as well, and their contact information is on our website. So
yeah,
the person who asked that question. Yep.
Yeah, very good.
Okay, I am going to switch screens. We do have a few questions about the presentation today. While you're thinking of some more questions, but while you're answering those, I will. Another question just came in that says, "What should be the order of withdrawal?"
The order of withdrawal. I'm not sure I understand that question.
Let's see if that person can expand on that while we let everybody answer these other questions quickly. And then that person that asked that question, maybe if you could think of how to expand on that question a little bit. I'm wondering if it's the order, if they should do Social Security or, yeah.
Oh, okay. Well, if
sure,
that's what we're referring to, in the scenario that I consider in the presentation, we're actually talking about simultaneous distributions. So, in other words, you'd be getting distributions from Social Security as well as from your own retirement investments. So in other words, you might get, let's say your lifestyle expectation is $50,000 a year, and you can expect from Social Security, let's just say half that, $25,000. Well, that means that the other $25,000 will have to come from somewhere else, and that could come from your own investments.
All right. While participants are thinking, if you do have any other questions, just a reminder that the next two sessions coming up are focusing more on home buying. So the first session will be steps you need to take when thinking of purchasing a home, and some different mortgage products that you can take a look at. And then the following week we'll be focusing specifically on home loans, points, and that type of thing. Just talking about different types of mortgages and different things to think about when looking at mortgages. Okay, it does not look like we've had any additional questions come in. Oh, here we do have one more. Luke, it is, where would you buy short-term bonds?
Good question. Now, Carrie can attest to this. In extension, we're not allowed to name any companies necessarily. Sometimes I do for example purposes, but I'm not going to recommend anything specific. I will say, when I refer to bonds in general, I'm talking about bond funds, so mostly talking about mutual fund bond type products. Where do you buy those? You can get them pretty much anywhere. I mean, anywhere you can invest money, you can usually find some type of a bond fund that you can invest in. So that's where I would start.
Okay, thank you. All right, well, thank you everyone for attending. Oh, and I just had a comment come in. It says that the resource links didn't work, so two of them didn't. We'll take a look at those and get those fixed for you as well. So the resources that are on the Solid Finance website, we'll take a look at those and make sure all of the links are working and get that fixed by the end of the week. So thank you for letting us know that.